Hello, and welcome to the third edition of the Cryptotesters live show. And today I have Kane with me. Needless to say that this is a personal highlight for me, but I also feel like this is an amazing timing to talk with Kane, because it feels like there's a lot going on at Synthetix at the moment. So first, Kane recently made a comeback at the head of the Synthetix Council, so taking a much more involved approach in the daily operations of the Synthetix protocol after having taken a step back. And then there's the launch on Optimism soon, which is a layer 2 solution which will make trading on Synthetix much more cheap and much more enjoyable. And at the same time, we also see a lot more competition at the moment in the derivatives space. So I'm also very curious to hear Kane's thoughts on that. But let's maybe start with a little introduction on Synthetix, because this is a show for onboarding people to DeFi and hopefully also to Synthetix. So with that being said, hi Kane.
And hey, thanks for having me.
Welcome. And maybe you can start by explaining how Synthetix works and what the main objective of this protocol is.
Yeah, so I think the main objective for Synthetix is to allow people to trade a range of different assets on Ethereum. So, obviously everyone knows Ethereum has tokens. It's got a bunch of different tokens. It's got DeFi tokens. It's got stable coins. It's got all kinds of different assets you can trade. What it doesn't do as well is trade things that mainly trade off-chain. Where most of the activity is off-chain. So, things like commodities, oil, silver, gold, even equities. So, things like Facebook and Amazon, etc. But even I think, with Ethereum, it doesn't necessarily do well with a lot of the other crypto assets, right? So, there's a lot of crypto assets that are not Ethereum native, which might be surprising to some people, but they do exist. Bitcoin and Litecoin and Doge and things like that have other blockchains. And so what Synthetix does is basically brings all those assets onto Ethereum so that people can trade them, and gives them the ability to convert these tokens that represent these different price feeds between each other. It's essentially a way for people to trade any asset that there's a price feed for.
Did you ever consider taking a different approach for, if your goal was to list, say, stocks or commodities, of taking a more centralized approach and somehow working with the traditional stock market to bring these assets on chain? Or was your vision always to, this would take too much time, let's do this the DeFi way?
So before I started Haven, which became Synthetix, I was running a payment gateway. We worked with a lot of the crypto exchanges. And so I had a lot of conversations with different people in crypto back then. This is 2014, 2015. There were a number of things going on. And there are a lot of different use cases that excited me about Ethereum. One of which I don't really talk about that often because it's kind of fallen by the wayside a little bit, is the idea of tokenized equity. So my payment gateway startup was a traditional startup. It had shareholders, it had a cap table, and there was this idea, I think, back then, which didn't really take off as well as people might have liked, of tokenized equity, right? A way of basically representing these equity shares as tokens and making them more tradable and liquid and all these sorts of things. And so I think that experience of kind of going pretty deep into that and speaking to a number of people who had projects that were working on that and really never seeing any of it materialize was kind of instructive, when we launched Synthetix and we pivoted to synthetic assets, to kind of realize that, the approach of taking off-chain assets and wrapping them in a token or whatever was going to be quite difficult versus, just creating a derivative or a synthetic version of it, by a price feed. I think it's a much more efficient approach. And obviously, it's worked quite well for us because we have, a range of different assets that we otherwise probably wouldn't be able to support. So,
I'm also personally very excited about tokenizing equity, and it's actually one of the use cases that I shill most often to people, because I love onboarding new people to DeFi, and often they point me to the fact that a lot of the activity in DeFi is circular, right? Like we're trading only crypto assets, lending crypto assets, and then I love to point to Synthetix actually and show how you can buy like a Facebook share or a Netflix share anywhere in the world. You don't need to KYC, etc. But do you have a feeling this is received well in the crypto space? Because I feel like the crypto people are so obsessed by crypto assets that they're not really interested in trading stocks. And so I'd like to hear if you're positively surprised by how it's received or kind of disappointed.
I think, trading equities for most people in crypto is like when you go to someone in TradFi and talk about trading FX with no leverage, right? Like, it's about as interesting as watching paint dry. So you can sit there and watch the Euro USD ratio all day, but if you're not trading with leverage, it doesn't really move much. It's not that exciting. And I think for crypto people, if you're used to 30% intraday moves, something that moves 2-3% is probably not going to, get your heart pumping at all. So I think for the people who are kind of day trading and highly speculative, really short time frame traders, it's probably not as exciting a value proposition. But I do think we have a range of different people with different needs and interests, and they're all kind of converging together. And there's a number of different things that we sort of need to put together for it to work. So on the crypto side, obviously, there's people who are really interested in trading crypto assets. What we haven't been able to deliver, I think, is like leverage, really low latency trading experience, an amazing UX with low fees. So for the crypto people, there's still probably, value trading in other venues, right? We haven't quite gotten there. Obviously, that's where Optimism, which I know we'll talk about a little bit later, comes in and should bridge that gap. Then on the other side, you've got, TradFi people or people who want exposure to equities, but maybe don't have a brokerage account. Maybe they're in like a, some emerging market or something like that. And the UX and onboarding process for them is not quite there. We don't have great fiat on ramps and off ramps. And so I think we're probably still, in a couple of years away from all of these things kind of converging and having really great scaling and really good on ramps and off ramps and all the things, all the components we need for this to kind of come together and for everyone to have a better experience trading on a decentralized exchange rather than going to a centralized venue or, TradFi venue.
Yeah, and once all of these building blocks come together, the optimism for low latency and the good UX and whatever, I think it's then also a marketing question, right? You need to then market this as a sort of Robin Hood for crypto and really target the emerging markets where maybe people don't have access to these equities.
Yeah, absolutely. And I think, the marketing question, people ask it all the time, right? They say like, why, is Synthetix so bad at marketing, right? And it's hard to answer that question, with a straight face sometimes, because we can say, well, we haven't tried to market it, but people kind of go, well, that's, it's an easy answer, right? Say, oh, we haven't really tried to market it yet. I come from a very kind of traditional startup growth hacking mindset, right? Like I was in online retail before I started the payment gateway that I started in 2014. That's a very, very brutal environment in terms of, generating growth and marketing, very low margins. You need to be extremely focused on how you engage customers, what your funnel is like, and, the efficiency of the funnel and all of your call to action, like all of that stuff has to just be nailed. And then someone looks at, say, staking.Synthetix and they go, that doesn't seem right. And the honest answer is that the funnel that we have had for a long time in crypto just wasn't really going to have the retention that we wanted. So on the staking side, I think we've done quite well. There's something like 7,000 to 10,000 people that stake Synthetix regularly. There's fairly good adoption within crypto there for how complex of a product it is. On the staking side, it's a few hundred people that are trading, on a monthly basis. So it's just not been an experience that we've felt comfortable really trying to push a lot of people into that funnel, because we know that the fees are high, that, there's all kinds of friction. But I think we're getting closer to a point where we can switch that on. And I'm pretty confident that when we do switch that on, the experience will be sufficiently sticky that we can really drive some people, into the ecosystem. So.
Do you already have some ideas on how you want to market this protocol or this product once you get there? Because I think marketing in the crypto space is also a very unexplored area, especially marketing to the mainstream. So curious if you have some ideas already, or if it's more in the future.
Yeah. So I think again, like, to go back to my the olden days, right? This is maybe a decade ago now. You want customer segmentation, right? You really want to understand who is the customer, what is their value prop, what is it that's going to kind of drive their behavior. And I think at the moment we've got these kind of concentric circles of crypto adoption, right? There's the deep DeFi degens that are just doing all kinds of crazy stuff and interacting directly with contracts, and then outside of that, you've got people that maybe only feel comfortable using a normal UI or MetaMask or something like that, and then the kind of circle gets wider and wider. At the moment, I think once you go sort of 3 rings out, you just fall off a cliff, right? There's not that many people there. I think it's getting better, and things like Compound launching this new service for tapping into these DeFi yields, I think is genius. I mean, the guys at Compound are very, very smart when it comes to the right products at the right time, and I think they've really got the timing right on this. There's a lot of interest and a lot of sort of institutional players, more sophisticated players that want to just have like a really simple approach to getting access to DeFi. So I think that could be quite a good on-ramp. But again, that's customer segmentation, right? Who is that? It's fintech companies, it's people with treasuries, it's these sorts of things. It isn't necessarily, someone in Southeast Asia who's got, an Android phone and a 4G connection or 5G connection who, needs an on-ramp to get into crypto, et cetera. So there's a bunch of different customer segments, and, we don't even have a strong sense yet within which of these segments there's going to be reasonable adoption and retention, right? So there's a lot of work that needs to happen once we get to that level that I think we're approaching, but we just haven't been there. We haven't had the infrastructure in place.
So something like Compound did with, I think it was Circle or Fireblocks, could be interesting for Synthetix eventually. So having some sort of centralized layer or intermediary that partners with a lot of fintechs that can then create neobanks with synthetic assets or synthetic stocks and commodities.
Of course, yeah. So I think the distribution for us is another question. It's another open question. What is the best distribution? We're seeing obviously much better wallets emerge. The wallet UX has gotten much better over the last 2 to 3 years, and integration of Synthetix into those wallets is definitely something that we've pushed. One of the challenges I think in that integration process has been that, particularly when it comes to trading, which is what people want, they want exposure to these different assets. The trading experience for a wallet in terms of integration has been really poor. There's been a number of reasons for that, architectural reasons, low-level reasons that we don't necessarily need to get into. It's kind of getting in the weeds, but suffice to say, the developer experience has just not been a great one. And so one of the advantages when we get onto Optimism is that composability and sort of integration component is going to get much, much better. And as these wallets start integrating more layer 2s and add Optimism, and obviously a lot of them have Polygon already, they add Arbitrum, like all these different layer 2 solutions are going to get integrated into the various wallets. And I think once that starts to happen, you'll see much, much better user experiences. And it'll be much easier for someone to get access. But we still haven't solved the entire flow because on-ramps and off-ramps is still challenging, et cetera. So it's still kind of a crypto native game.
Yeah, it's definitely a long journey. It's one of the hardest challenges that you've chosen for Synthetix, but it would be super rewarding once you nail that whole experience.
Agreed.
Can you explain a little bit how these synthetic assets are really created and how you make sure that every synthetic asset can be redeemed against its US dollar price at any time? And maybe you can also segment into the different stakeholders in the synthetic system. You have the normal traders, and then you have the stakers, the ones that are actually making this system possible. Would love to hear how it works.
Yeah, so I guess at a high level, without kind of freaking anyone out with too much complexity or sort of technical detail, you have people who provide the underlying collateral. The people who provide the value, and they lock that value, and they basically say, "I'm going to lock these assets that we've got external markets for. We can say this is how much that asset's priced, and it's fairly liquid. And out of that asset that I've locked, I'm going to generate a synthetic asset." And I'm going to generate a synthetic asset that tracks the US dollar. And then once I've generated that synthetic US dollar, I can convert it into any asset that we have a price feed for. So we use Chainlink for our price feeds. I think there's, last time I checked, maybe 25 or 30 price feeds, something like that. And so, including some indices and various other things. So you've got these price feeds, and you have a right, if you're holding a synthetic asset, to convert that synthetic asset into any other asset that Synthetix supports at the price of the oracle at that time. And so the traders who make those trades or do the conversions or buy and sell these synthetic assets pay a fee to the protocol. And that protocol fee goes into a fee pool, and all of the people who at the start locked their assets, locked their SNX tokens in order to issue these synthetic assets, get a share of that fee pool. And so you've got this, very powerful flywheel where, as the network starts to grow, obviously the value that's flowing back to the people who are providing that service, that are the backstops of the network, that kind of fee yield goes up. The value of the asset goes up, and you can generate more synthetic assets, get more trading activity. And I think we've sort of seen this over the last 12 months, particularly with Synthetix, where Synthetix is very deeply embedded into a number of different protocols. It's got a lot of liquidity on Balancer, on Curve, in Uniswap, and in various different places. And particularly when it comes to things like cross-asset swaps. So there's a lot of different synthetic Bitcoin implementations and wrapped Bitcoin and things like that. We're pretty embedded in that Bitcoin, represented Bitcoin on Ethereum. Same thing with things like Euro. We're one of the largest Euro stablecoins, maybe the largest Euro stablecoin now. So there's all these different assets that we kind of tap into and have kind of integrated ourselves into the rest of the DeFi ecosystem, lending and DEXs, et cetera.
I'm actually going to pull up the Quenta website to make it a bit more tangible.
Got it.
I feel like there's often some confusion. Like some people think that you have to be a staker in order to trade, but actually, anyone can just on-ramp into this or use this exchange and buy any of these synthetic assets, and they don't even need to have SUSD, for example. They can just on-ramp with ETH or USDC and then buy any of these assets.
It's a little bit like, you don't need to be a Uniswap LP to use Uniswap, right? Like, the vast majority of people who use Uniswap are not providing liquidity. They're not liquidity providers. They're just people who want to get access to the liquidity on the DEX. So, you don't have to know anything about staking, anything about the SNX token or anything. You just have some ETH or stable coins and you can turn up and trade.
Yeah. And then you have, on the other hand, you have the stakers, who they are the ones that are actually underwriting all of these synthetic assets that the traders can see on Quenta, on the trading platform. They are the ones underwriting all of these different synthetic assets, correct?
That's right. Yeah, correct. Yeah. Yep. So they lock their SNX tokens as collateral and issue the synthetic assets. So they provide the backstop for the network.
So in my case, I've connected a wallet here. I have staked some SNX, and then I have minted some SUSD that are here in my wallet. And then this is part of the debt pool. And so I always, when I explain it from the staking perspective, I always say it's a bit like Maker, in the sense that you can mint some dollar-denominated debt. In the case of SNX, that's SUSD. And you also minted with some crypto asset. In the case of Synthetix, that's SNX. The difference is that in Maker, your debt is individual, right? So if I borrow 1,000 DAI, then in 1 year I will owe 1,000 DAI plus whatever interest has accrued. In the case of Synthetix, my debt is actually part of a debt pool, and we can see this debt pool here. And this debt pool collateralizes all of the synthetic assets that we've seen here. So if in an extreme example, if let's say all of the traders would buy synthetic gold and synthetic gold would go to the moon, then my debt would rise, my $1,000 debt would rise a lot more than in the case of Maker, right? Because
that's right.
I am making sure that they can redeem it for for more dollars than what
exactly. You're responsible for being the counterparty to those trades essentially. You're kind of being the backstop of the network. So I think an important point though that people sometimes miss is, as a staker, yes, you're in this pool, and therefore, you put your assets in, people are trading, and to an extent, you can't control what they trade, right? There's some limitations on what they can do, but ultimately, they've got liquidity. They can move in and out, and you want them to. You want them to trade as much as possible. You want them to go from ETH to BTC to USD to Euro, and pay fees all the way through, right? Because those are the trading fees that are covering the service that you're providing. But you're also responsible, as if you look down, through this list here, you're responsible for hedging your exposure to this debt pool, right? So you're not just sitting there passively kind of hoping that a bunch of fees happen. You need to actually look at what the debt pool composition is, and you need to kind of try and mirror that as closely as possible. And so the nice thing about that is, even though individual traders are moving around a lot and making these large trades, and there's a lot of volume these days, it's in the tens of millions or hundreds of millions a day, the debt pool itself doesn't fluctuate that much, right? It fluctuates a bit more slowly. It's not as volatile. So you can kind of go in and hedge once a week or so and say, okay, I need this much Bitcoin, I need 10% Bitcoin, I need 5% Euro, 3% Link or whatever, and you hedge that position to ensure that as the debt pool moves, your assets are moving the same way.
Yeah, I was actually going to ask you, as a small staker, I'm let's say I'm not super the big trader who monitors the debt pool at all times and knows how to hedge. How would you recommend to behave, essentially? To imagine now I have my 5,000 SUSD. Should I keep them? I know you can, for example, provide liquidity on Curve. So put SUSD into a liquidity pool, and then I earn trading fees and so on. But what do you think? Is there like an answer, like a general answer, like this is the best way to hedge yourself, or is it really more like you have to kind of assess the situation?
Unfortunately, the staking game is a competitive game. It's not necessarily a zero sum game, but it's you're competing with other stakers. It's zero sum in terms of the yield that you can get, but you can hedge your debt externally without necessarily affecting the other players in the game, the other stakers. So one of the simple ways, I think, for a smaller staker is to put, for example, your SNX into a staking pool. And there's a few. There's Wirearn, there's X Token. There's a couple of different options there. You can also take your synths after you've staked. So take that SUSD and you could put it into the DHedge debt tracking pool, for example, which attempts to track the debt pool. It's obviously not perfect. None of these solutions are sort of perfect. But the optimal thing in terms of kind of maximizing your return is really to do it yourself. And to monitor the debt pool and hedge it yourself. But obviously the transaction fees can get expensive there, and so you need to kind of try and find what the line is for you and work out how. So I think in Discord they sort of say if you're under like 5,000 SNX or something like that, at the moment it's better to be on L2 because you don't need to hedge because trading is not enabled. Even I think most likely after trading is enabled, which hopefully will be pretty soon, it'll still probably be a little bit easier to hedge because there won't be that many assets. There'll only be Bitcoin, ETH, and Link. So it won't be that hard to hedge the debt pool, compared to L1. But again, there's no simple answer for everyone, right? It really depends on your risk tolerance, how savvy you are, how active you want to be, etc.
Okay, makes sense. And yeah, in terms of synthetic assets, how come? I mean, there are already a few, right? I mean, at least the big American tech stocks that are probably the most popular, especially among young demographics. Like, how come you haven't added more assets? Like, let's say all of the assets on all of the stock markets, since it's literally, as you said, it's just a derivative. You can create it out of thin air. Basically, you just need a price feed.
Yeah, you can. Unfortunately, the price feeds on layer one are not free. There's sort of a cost to maintaining those price feeds, gas costs to publish the prices regularly. And so there are some limitations both at a protocol level, at the Oracle level, and ideally we want to ensure that any asset that we're listing is going to have a reasonable amount of activity. Because if it doesn't have much activity, then that creates overheads for not much return for the protocol. Obviously, that changes a little bit on L2. On Optimism, it'll be far cheaper, and so it'll be easier to have a wider range of assets, and that is the expectation, as well as other asset classes. A wider range of shorting options and loans and futures and various other things that will be enabled by L2.
Are you ever concerned that the debt pool could get out of hand and some assets in there just go completely nuts, and then you can't meet obligations? I mean, just like a lot of SNX stakers get liquidated.
Always.
It must be quite stressful, no?
Yeah, I'm always concerned by that.
Yeah. I was, I'm also an SNX staker, and when crypto was going just up and up and up for a couple of months, and it was just like crazy at what rate, I was sweating in that as a staker, right? Because you don't know
the interesting
at what point it will stop.
Yeah, true. I think the interesting thing about that is, the OG Synthetix people, have been around for a long time. They've been through a number of cycles. They've seen what happens to the debt pool. And the nice thing about Synthetix that I think people don't often realize is that hedging the debt pool does not necessarily, and some people would kind of in Discord might freak out, maybe Spreak or someone might start screaming at the screen if he's watching this. But it's not necessarily a game of attempting to get to neutral, right? You can outperform the debt pool. So, for example, if you were in, ETH only, let's say on the 1st of January, right? You minted you locked at whatever 10,000 SNX, and I think at that time it might have been 50 grand, and you got $10,000 with SUSD, right? You have just got an interest-free loan, right? Leverage on this very liquid SUSD asset that allows you to trade into anything, right? Now, if you had taken that and you converted that SUSD into ETH, right? I think ETH, I can't even remember, it was like 800, 700 or something like that, right? The debt pool was probably 25% ETH, I think at that time, or maybe 25% Bitcoin. There's a bunch of euros, a bunch of US dollars. So if you put everything into ETH, right? So you only needed to put 50% into ETH, let's say, to hedge it, but you put 100% into ETH. You would have, at the end of that period, your debt would have gone up by 3x or something like that. But the value of the loan that you'd converted into ETH would have gone up 7x or 8x, right? So you could actually take the ETH, sell it down, pay off your entire debt, even though it's going up, and have profit. So it is, and I mean, for me, this has been my strategy for years now, right? Like I've just go long every time SNX go long ETH, right? Like I'm YOLOing into ETH every time. Like even today, the price of SNX went up. we were able to mint some more stable coins, and I'm like, okay, let's put some more into ETH, right? Let's, we had to sell down some ETH to pay down debt when SNX pulled back, so let's rebuild that ETH position. And so I've been able to build a very, very large ETH position off the back of the fact that you've got this leverage that's built into the SNX token. It doesn't cost you anything. It's kind of free. Plus, you then get the yield from fees and everything. So it's there's a lot of complexity, obviously, but
that's actually quite cool that it's literally the only interest-free loan in DeFi, I think, right? You don't pay any interest rate. I mean, you're taking on some risk, obviously. But
you're taking on risk of the debt pool. But if you think you can outperform the debt pool, which I think myself and the other degens out there probably think they can, and I will say definitively, I outperform the debt pool significantly, like probably by 2 or 3x over the last 6 to 12 months. So it's possible to do. If you're directionally long, you can go long ETH and outperform the debt pool.
Okay. And yeah, I mean, the dream for the debt pool in aggregate would of course be that at some point you have so many
neutral,
different exactly, that you have so many different assets that are uncorrelated with each other, that even if one goes up, like the other one goes down. And so, but it's hard, right? And because I feel like everything is correlated in
everything's correlated. Yeah. The everything bubble kind of makes that a bit challenging, right? It's either risk on or risk off, and everything goes up or down. That said, obviously Forex and gold and silver is less volatile, right? So if there's a lot of gold and silver and oil and various other things, then over the entire debt pool, it should be less volatile. But as you can see here, the vast majority of the debt pool is still in crypto assets. So
and then you also offer the inverse assets, right? For every synthetic asset, there's the inverse, so people can actually go short. And that's also, I mean, if these become popular, I don't know what the state is. It looks like people.
ETH is still the most popular asset by far. Yeah.
In the inverse category, right?
Yeah, so the ETH situation is kind of interesting at the moment, because we have this mechanism that you can borrow synthetic Ether against your ETH 1-to-1. A lot of people, because the demand for synths has been exceeding supply for a while, they've been trading above the peg. And so what this mechanism allowed people to do is borrow, again, with no interest, against their ETH and get synthetic ETH. What that creates is an arbitrage loop where effectively that ETH is sold into synthetic dollars to arbitrage curve pools and various other places where there's liquidity shortfall. And that's effectively created a situation where the debt pool has more short exposure to ETH than long exposure.
Okay, interesting. So that means that if ETH rallies now, the debt pool will
go down. Yeah.
So that's okay. So that's cool for me as a staker.
If you're an ETH bull, if you're an ETH bull, you can sit in stable coins and you're basically going to be outperforming the debt pool just by sitting neutrally. So, but if you're bearish on ETH, then the optimal strategy is you got to go out and actually open up a short position somehow. So go to Aave, borrow ETH and sell it. Use your SUSD. Lock that, borrow ETH against it, and short it effectively to open up a short position. That's the optimal strategy to stay neutral if you're bearish on ETH or neutral. If you're bullish on ETH and you think that we're going to rally from here, then being neutral to ETH skewed will you'll outperform the debt pool by even more if you're long ETH.
Well, I mean, we've touched on a lot of features and cool things to do. What would you say is the killer feature of Synthetix? Because there's so many like features and it has so many like facets. So what would you say is the thing where you see like people are really like using it and loving it for that particular thing?
At the moment, the killer feature is getting access to these yields. So taking synthetic assets and putting them into Curve, Balancer, Uniswap, etc., and being able to act as an LP, either by using stablecoins or other synthetic assets against their other ERC20 or ETH-based assets. That's kind of the main driver of demand for synths at the moment. There's growing volume. The volume has been growing over the last kind of 3 to 6 months. But I think until we've got really sort of low latency trading and low fee trading on L2 that's composable, I don't think we'll see the trading experience necessarily blowing up. As I said, it's doing well, but I don't think it's driving the majority of the demand. The majority of the demand is coming from people who want to be liquidity providers in various different places and use those synths to essentially be a market maker.
Yeah, I love this dashboard, by the way. I hadn't checked it for like 2 months or something, and I feel like there's so many new informations on there. It's really cool to check it out.
It's quite interesting to see where the SUSD is, right? When you look there, you're like, okay, it's not just all sitting in one place, right? There's big chunks in different areas. So
yeah, for sure. Let's talk a little bit about Optimism, because you guys have decided very early on that you would wait. I'm gonna unshare my screen.
Sure.
But you guys have decided very early on that you would choose Optimism as your scaling solution. Then unfortunately it got delayed a little bit, so I guess that must have not been too nice for you, but now we're getting there and you must be super excited. What's the plan? How will the whole experience look like for both normal users and SNX stakers once you're fully live on Optimism?
So the nice thing is that SNX stakers have been able to stake on L2 for 5 months now, 4 or 5 months now. So we've got a really good sense of what the staking experience looks like for L2 stakers. And the honest truth is it's much better than the L1 staking experience. The UX is better, costs are lower. It's much easier to be more active. You can kind of you can mint and burn and claim and do all that stuff much more effectively. What we haven't yet seen is what the experience looks like when we have much higher volume from trading, because trading is not yet enabled. So, I think hopefully we'll have trading enabled soon. We've said that a few times now. I think we're getting closer and closer to the point where I feel more and more confident that we're not too far away. Optimism has finalized a couple of things that were kind of critical to enabling some integrations like Chainlink and some of the stuff that we were doing. So it's all converging at the moment. Optimism is switching on fees paid in WETH, which were ETH, I guess, in their case, but effectively it's a wrapped ETH token. So there's a number of cool things that are happening like this week and next week. So I'm feeling pretty good about things.
Will the synthetic assets that will be available for trading on Optimism, will they be created uniquely by the debt pool that is on Optimism?
They will, initially.
Okay.
Initially.
Okay.
Yeah.
And eventually, I guess you can then also bridge synthetic assets over that come from the debt pool of Ethereum. But there will be those are two different instances with their unique debt pool and obligations and so on.
Exactly. Yeah. So initially there will be two different debt pools. They'll be distinct. Over time, over the next probably couple of months, we will enable the debt pools to be merged. Right. So it'll be a shared debt pool across both. And then very soon after that, we'll enable movement of synths across the different chains. And then by that time, we'll have a wider range of assets enabled for trading on L2. There should be more liquidity in places like Uniswap and some of the other lending protocols and things like that. So we should have a kind of nascent liquid ecosystem emerging on Optimism, ideally, which will make it much easier for people to migrate across and start staking and trading and hedging and doing all the stuff they need to do there.
Amazing. Do you also think that, you said one of the limitations to add more assets currently is the absence of feeds or Oracle feeds for all of these assets. And we know that one of the reasons that you don't have feeds for all of like long tail assets is that it's too expensive to maintain them because on Ethereum gas fees are high, etc.
Yeah.
So do you think you might have a situation where you'll have more price feeds on Optimism because it's cheaper than on Ethereum?
Yeah, so the challenge is there's no marginal saving if you add an additional price feed of the same asset that's already on L1, right? And so what we're going to need to do is look at the assets that are on L1 and work out which assets genuinely have traction and which don't, particularly as the trading experience gets much better on L2. There's just going to be some things that people are not likely to trade on L1, most likely, right? If they want access to it, they may, purchase it on L2 or trade into it on L2 and then transfer across to L1 if they want to hold it on L1 for some reason. But there's just certain things that I think will maybe not have native exchanging functionality on L1. So, that's something that the protocol is going to need to decide, because I'd say somewhere on the order of, for every price feed we switch off on L1, we probably get 10 price feeds on L2. So that makes the expansion from 30 to 300. If you switched everything off on L1, you probably get 300 or 400 feeds on L2. So I think we will see a much longer tail distribution of assets being supported on L2, but the transition will take time.
Do you expect the trading experience to be like amazing from the get-go and everyone rushes in, or do you think it will be a slow process, which would be totally normal? But
I mean, the thing that we saw on the Optimism trading competition that we did, which is now going back a long ways, right? Last year, mid last year
as well.
Yeah, it was mind blowing, right? And I think one of the biggest frustrations that everyone has at the moment is they remember what that experience was like, and the current experience is just not even close, right? So it's been a year of like this tease of this is what you're going to get, and then a year later it hasn't emerged. So my expectation is that the experience will be as good as that, if not better. There's been a number of UX improvements and things like having Etherscan supporting Optimism and all the stuff you expect on L1. Like a lot of that stuff's kind of matured over the last year. But I fully expect that the main limiting factor will be the number of assets initially, but the experience itself is going to be really powerful. We all remember what it was like trading on the optimistic demo back in the day, and it was pretty magical. So
the problem with the demo is people think like, okay, if it's working on a demo as a testnet, well, it must
why
be
can't
almost,
I know, right?
done,
Yeah,
right?
Yeah, I know.
And about scaling, I mean, there was a lot of projects that chose Polygon in the sort of interim phase where Optimism wasn't live. Like Aave, for example, did it, and I mean, probably they're going to launch on Optimism and other solutions soon as well. But for that whole interim phase, it seems like it was kind of a good decision because they got liquidity mining rewards, and they boosted their TVL, and also just to see how this product work in a low fee environment. Do you, with hindsight, do you regret also not having launched on Polygon, or do you think like we needed to focus so much on getting this Optimism thing right? Like we need to concentrate on that.
Yeah, I mean, look, there's no question that we have absorbed a lot of pain for the other DeFi protocols in getting to where Optimism is now. And someone needed to absorb that. We are kind of gluttons for punishment sometimes. I think it's Synthetix. We like to do really crazy, hard things. And so I think, yeah, exactly. Just like keep stabbing us, right, and we'll keep fighting. So I think the reality is someone needed to take that pain. It was going to be probably too difficult, and we talked to Polygon multiple times. It was probably going to be too difficult to run 3 parallel streams, L1, because you still need to maintain L1, right? So L1, L2, and or Optimism and Polygon would have been, I think, probably too much to handle, and would have made things harder. And also, knowing what we knew back then, the expectation was that we would have exchanges ready in March, right? So last time I checked, we're a little ways away from March. So that's been disappointing, obviously, that it's taken this long. But the expectation was fully that we'd be ready in one of the first protocols live in March. And if that had been the case, then Polygon didn't really start to take off until April, May or something like that. So, like these are all, it feels really painful now, right? And trust me, it feels very painful for me. But I think in 6 months' time, like if you ask the average person, which happened first, right? Like the Shanghai DOS attacks or the DAO hacker, or like people don't know. Like it's all just ancient history, right? So these things will compress and people forget about them, and it'll just be water under the bridge.
I mean, you're gonna have a head start on Optimism, because I feel like, as a team, this ecosystem with all its technical challenges probably better than anyone else. And also, I just feel like for a system like Aave, it's probably easier to deploy on other chains because the protocol in itself is just less complex. It feels like Synthetix is, it becomes very difficult, as you said, to maintain different instances on different chains. I always forget when I do a live that I have people also post comments. So I just,
I can't see the comment stream. Thankfully, it's usually a bit distracting. So
if you click on the right, you see comments on the top right somewhere. But otherwise, I can read it to you. I think there's one that is worth asking. How and when will we see the adoption of DAOs in the traditional startup world?
Yeah, that's a good question. I mean, if you've read my recent post, right, about capital formation, I think in a traditional startup, to launch with a DAO is probably a disadvantage right now, realistically, in terms of your ability to access capital, right? Because if you turn up, right, we saw this movie in 2017, right? I think most crypto investors are not signing up for burger delivery on the blockchain or whatever crazy scheme people are cooking up, right? So the idea of turning up with a traditional startup model and trying to bolt it onto crypto, I think is going to be a hard sell. And similarly, if you go to traditional startup investors who don't get crypto or whatever, and say, this is not going to be a cap table with a normal safe node and all of the things that they expect, you just got to send some USDC into a contract on Ethereum, they're going to think you have two heads, right? So I think it's hard to bridge that gap. I think it will get easier maybe, but it will particularly, I think, become easier for people who want to access capital in markets that maybe there isn't a strong VC presence, but it's still not quite there. I think we're going to need we'll need to see some really successful DAO first crypto native things kind of break out into the mainstream, and people go, oh wow, how did this happen? They look at the history and they find out, oh, it launched as a DAO and they have governance and all these things. That will kind of seed the process, I think, for people to then go out and use it for traditional startups, but we're not ready yet, I don't think.
Yeah, I feel like also the big difference with DeFi protocols is that the product lives on chain. So when you do like votes and all of that, you can actually trigger the protocol changes, whereas if the business lives off chain, then it kind of becomes a question like, why do you have the DAO in the first place? But I think it could be cool for like charities, NGOs that form on the web, like, and people are all over the world, and then you use like Snapshot for like doing votes more effectively and having a token just to coordinate around it. But I agree, it will take some time. And then I wanted to ask you about competition. So when I said to like DeFi friends that I would have you on the show, people ask me like to ask you about Luna and what you think about that. I haven't used it personally, but how do the two projects differ in sort of from the tech or just a different focus? I know they live on different chains, but what's the main?
I mean, I have a long history with the Terra guys. We go way back. There's a funny story where I think we were on a stage together in like mid 2017 or something, and there was like a panel of 5 people, and Doe was sitting next to me, and they kind of called out randomly and said, "Okay, like you say what you're doing, you say," and I'd never heard of the project before, and Doe's like, "We're a crypto collateralized payment network. And like, I was like, sorry, what are you? Because like, you know, it was literally the exact same project, right? You know, with a slightly different tweak to the mechanism. And so it was kind of funny. We talked afterwards and it's like, oh yeah, you know, we really like your white paper and, you know, all this stuff. And obviously they were going after the market in Korea. But then I think the fact that they then subsequently, like us, pivoted away from this payment network into like synthetic assets is kind of, I don't know. There's a certain point where like I just have to laugh. It's kind of funny.
Maybe he wants to do everything like you.
Yeah, like, you know, I think look, you know, there's not that many solutions out there in you know what we're doing. Obviously, there's a lot of lending protocols, there's a lot of dexes, you know, there's a lot of derivatives protocols. I think the main thing that they've done really well in recent times is their liquidity incentives. You know, they're smart guys. They learn from everyone what everyone's doing, right? You know, not just Synthetix, but other protocols as well. And I think their liquidity incentives have created a really powerful flywheel for generating synthetic assets. I think, you know, we have an incentive for people to stake, but I think that they've gone a bit deeper into like synthetic asset generation. So, you know, obviously the big question for all of us is, okay, great, you're paying protocol incentives to create this flywheel. Does it become self-sustaining? Is there genuine economic activity underlying it? And I think that's the question that we're all going to be asked over the next, you know, couple of years as inflation tapers off and you need to, you know, actually show genuine cash flow and revenue generation.
So you mean bigger focus on asset generation, meaning that people are actually incentivized to create these
to mint the synthetic assets. Yeah, they're the different synthetic assets, right? They've got these pools that they pay inflation to go in and create liquidity into these different synthetic pools. Yeah.
So actually, each asset has its own pool there, where
it's distinct. Yeah. Interesting. So yeah, it's a different model to the Synthetix pooled model. It's different, you know, more like a UMA. You know, kind of a slightly different model.
Yeah. Let's talk a little bit about your recent comeback as the head of the council, or what exactly the title is. But
I don't think the other council members would appreciate head of the council. I don't think there's a head of the council.
So you're just one council member?
I'm just a council member.
Okay. So the comeback is not as crazy as it sounds like then?
Not as crazy. No, my post, you know, was somewhat tongue-in-cheek, right, about the dictator coming back. I don't actually have dictatorial powers anymore, unfortunately. I got to go through governance now.
So tell us a bit, how does Synthetix governance work? If don't need to go like crazy into detail, but is it like, so this council, what power does it have?
So Synthetix, you know, we try it like everyone, right? Like there's a lot of experiments going on and you try and pick and choose the things that work and you definitely try and avoid the things that don't work. And one of the things that we said very early on that we were very skeptical about was direct on-chain voting, right? For all kinds of reasons. You know, there's this chilling effect of whales with too much power. There's voter apathy. There's, you know, information overload. There's like literally the list of things that are bad about direct on-chain voting is much longer than the list of things that are good, right? And so we avoided that for a long time. And we had our own mechanism for enabling people to vote on things within the community. It was based on essentially identity, right? And it was kind of civil resistant because you were in Discord, you built up a presence, and yeah, there were some people with some alt accounts and stuff like that. But generally, you know, there was reasonable consensus and it kind of worked. So then we said, okay, it was not on chain. This is just voting in Discord, right? Like it was just, you know, you have an identity in Discord, one person, one vote, that sort of thing. We would typically have a couple of hundred votes on a proposal. You know, we had a Discord at that time of 5,000 people or something like that. So, you know, it wasn't an amazing amount of kind of, you know, voter turnout. And, you know, I think we had 20,000 token holders, right? So it was even less, but it wasn't really about token holders, it was about people in the community. So we then said, okay, we want to scale this out, right? Like Discord voting is eventually going to be attacked, and it started to be attacked. People started Sybil attacking it. They started creating a bunch of alt accounts and trying to create sock puppet, all kinds of stuff, right? And so we said, okay, we need to get a bit more adversarial here and come up with something that's going to be more scalable. And so we came up with something that we thought preserved the key things that had been working about that. One of which was whale resistance, right? Like now, as a whale myself, like that's obviously not in my best interest, but from the perspective of the protocol, we don't want one person or two people or three people to be able to say, this is what we're going to do, right? Otherwise, you might as well just make me the dictator and let me do whatever I want. And so we said, okay, how can we get as close to possible, as close as we can to one person, one vote? And the way that we did that was we said, you can vote in a representative democracy for a council member. So if you're a whale and there's someone that says like, I'm going to give all the money to the whales, right? And all the whales pile in behind that one person, that person gets one council seat out of 8. Right. And maybe the whales can kind of collude and get 3 seats or 4 seats, but it gets progressively harder. Right. And one other component that we did to kind of reduce that as well was we weighted your votes based on participation. So you needed to be staking. So you couldn't just borrow tokens and vote from them. You had to stake them. And then we also applied a scaling factor. So we scaled back votes based on the size. So it was like quadratic, like inverse quadratic voting, right? So instead of it cost you much more per vote the bigger you were, essentially, right? And so if you were someone who had 16 tokens, right? You ended up in a similar situation to someone who had a much smaller stake, right? A couple of people with 4 tokens, whatever. So that had an even greater effect, right? Because then where previously, if you kind of modeled it out, the 10 top accounts could have gotten like 3 council members or 4 if they'd all colluded together, it cut it down to 1 or 2. And so then we had this thing where you vote for someone who's your representative on this council, and the council decides all the parameter changes, which they did, and they did really successfully for about 6 months. And then we said, okay, now the council will decide the protocol changes, like actual architectural changes, not just parameters, but you're going to decide, do we do X over Y? Do we, add this synth or remove this or whatever, which they've been doing now for about 6 months as well. So this governance process has kind of evolved over the last year, and it's fairly different to, other people have kind of DAOs or multi-sigs where it's a few people that choose, but they're not elected people. It's not a representative democracy. Other people have direct voting. We've got this hybrid, which in my personal opinion, I think it's one of the better models out there. And we've seen more projects adopt it over the last kind of 2 to 3 months.
And these council members, how does it work when they have to decide some specific decision?
They've got an NFT that they can vote with, and they all vote. And we've got one more mechanism within this where if your council member votes for something you don't like, you can actually dilute them. So you can pull weight from them. So you can prevent a quorum being reached or or a majority being reached, depending on what the voting weight is and depending on how much they're diluted.
So you can, like, later after you have elected some council member, you can kind of pull your vote back from that person.
So let's say you voted for me, and I hope you did, as an SNX staker. If you don't like if I vote for something, right, and I'm the deciding vote, you can actually pull your tokens from me, and you as a single person on a 5 to 4 vote or whatever, 5 to 3 vote can actually prevent a majority being reached. Okay. So there's some checks and balances to ensure that people don't overextend their power.
Yeah, it's really cool that you can then also see how these council members vote on things, because I know often, you have in different DAOs, you have the concept of like voting for a multisig that does things, but you don't really know what they do on a daily basis. You just it's kind of like a vote of confidence, which is also okay. But I like that you can see what the elected council members do on a daily basis.
Sorry, I'm just looking at someone talking about Synth blowing up Twitter. I didn't say there was news, but anyway, I'm gonna have a conversation with that guy. He loves to drop some leaks wherever he can. But yeah, so I think we've got the Synthetix approach is take small components, right? Make small iterative changes and build them up into complex systems, right? It's incredibly difficult. Like if you look at complexity theory, you cannot build a complex system top down. You can't just start and say like, yep, this is all this complex edifice and here it is, right? That's auger basically, right? Like we've seen how that works out for you. You need to start from small components that work, that are tested, battle hardened, and slowly piece those small little components together to build something up and get emergent complexity rather than fiat complexity, if you will.
Mm-hmm. Yeah, it's definitely nice also to see how excited the Synthetix community got with your involvement.
Unintentional alpha leak. Yeah.
And maybe just to finish, because we're reaching the hour. I saw on Twitter. Wait, maybe I'm going to share the screen. That you wrote that you basically screwed up and lost a lot by staking SNX. 18 months of ETH profit. That sounds like a lot, knowing how long you are on ETH. So what happened? Maybe we can learn from your mistake.
So basically, as I said, right, Synthetix is leverage, right? Yeah. You've got SNX and you're levering up on that, right? And you need to be very fucking careful when you're using leverage in crypto. Even small leverage, even, it's not high leverage, right? It's you're not going 2 to 1, 3 to 1, whatever leverage, right? It's 0.25 to 1 or whatever, right? Yet you can still really get yourself in trouble. So obviously, as I described, right, you YOLO into ETH every moment you can, right? You can imagine that was going pretty well up to about 4K. At 4K, the SNX price popped a little bit, and I minted a bunch of SUSD, and I YOLO'd into a lot of ETH, let's just say, and that was at 4K, right? And the reason why I did that, I almost single-handedly put it down to Anthony Sassano, because he was shaming Eric for saying like ETH can't get to 5K and all this stuff, right? And I've been saying for such a long time, like ETH at 5K is just insane, right? Like I can see it now, maybe, but like it just like it feels like it's almost inevitable, but it just felt so crazy for someone who's been in ETH since like $5, right? Like it just didn't 1,000x, like that was a number that just was psychologically too big for me to kind of get my head around. And so it got to 4,300, and then there was a little dip, what I thought was the dip, right? And I was like, all right, I'm buying the dip, and I just YOLO'd in and just unloaded all my SUSD into ETH, which, as you can imagine, didn't work out very well. And then we got to a point where it pulled back, and I was like, all right, I've got to pay down my debt. So I had two options. I could take my medicine at 3,500, sell down that ETH, take the loss, and say, yep, no problem. Like that was lesson learned, right? I've got to pay down my debts. I've got to sell my ETH. Instead, I took that ETH and I borrowed SUSD against the ETH, effectively doubling my leverage at about a 150% ratio, right? Now we know what happens next is ETH goes from 3,500 to 3,000. And at that point I should have taken my medicine, but I was like, no, it's just a small dip. Like we're coming back here. And I basically got liquidated significantly. And there's a 10% liquidation penalty in Synthetix if you borrow SUSD with ETH. So that liquidation penalty was very, very painful. And I ended up having to sell a bunch of ETH to cover the debt that I, minted up at 4K, at like, I think the average was like 1,700. So you can imagine that's a pretty big loss buying ETH at 4K and selling it at 1,700. So that's my high level story of how you have to be very careful with leverage.
Yeah, it sounds very similar to my story, just that it wasn't on leverage, but I also bought the dip like again and again, thinking, we'd rally back up, but it just went more down. But I think following Anthony Sassano in the bull market is dangerous. He's very, very bullish. And when you read his tweets, you just want to buy also more.
Yeah,
so
I know. I mean, look, I'm not going to lie, right? Every time that I bought ETH after reading a Sassano tweet at 200 and 250 and 500, right? I'm not regretting those ones. So, swings and roundabouts, I think.
I actually just remembered that I also wanted to, last question, I wanted to ask you about the projects launching on Synthetix, it feels like there's a whole spring of projects building on Synthetix. That's super cool, and maybe you can explain how it fits into the whole strategy.
Yeah, so it's kind of an interesting dynamic that we have here, right? I think the kind of opposite end of the spectrum to me might be Andre, right? Andre's always giving me shit about tokens and too many tokens. We've got too many projects and do stuff without tokens, etc. I'm very strongly of the belief that tokens are a very powerful coordination mechanism, right? If you want to build governance, if you want to build a community, if you want to get people bought in, if you want to be able to do growth hacking and bootstrapping, all that stuff, a token is very powerful, right? Because you can give away the future value in the network to people early on. Without that, it becomes much more challenging, right? Now, if you're Andre and you're a crazy genius and you can just build something and it magically is amazing from day zero, maybe you can forego a token, right? But I think for the rest of us, tokens are very powerful leverage, and they can be used to bootstrap things. So we've got a number of projects that are being spun out or have been kind of semi-incubated or building on Synthetix. So there's Lyra, which is an options protocol. It's building on Synthetix. It's going to use Synthetix for. So they're running their testnet at the moment. I think they've got a competition launching pretty soon. Really nice amazing. UX. Yeah, it's really good, and that's going to be Optimism native as well. So it's not even going to be on L1. It's going to be L2 native from day zero.
And they're hedging
using Synthetix.
Exactly. That's amazing. I think it's one of the first option protocols. They're doing that. So it's not just like
it's really cool.
It's not just like a project that does something on Synthetix. It's actually, it could become a very big option protocol by and of itself.
I'm really bullish on Lyra, and I'm an investor in a couple of different options protocols, but I'm pretty bullish on this one. On staying with options, Thales, which is basically a spun out project that's taking the binary options contracts that Synthetix built, extending them, improving trading, etc. So that's going to be really cool. I'm really excited for that. They've got this started as like, how do we make the binary options better that we built in Synthetix, last year? And this is kind of the end result of that. So super cool project. I'm really bullish on options. I'm excited about this one as well. And then we're spinning out Quenta. So Quenta, if you showed it, it's the user interface. We're basically allowing that project to kind of form its own community and its own core contributors and kind of fork off, because Synthetix is a very big project. There's a lot of people, there's a lot of stakeholders. It can be quite hard to kind of operate within that very large framework. So to give them a bit of freedom and send them off, they're going to spin out. And then the final one is like a little side project that started with the tweet from Mariano and some people on Twitter. That's basically like a SPAC protocol for Ethereum. So you can go out and raise a pool of funds and then go and source a deal, connect the pool of funds to the deal. It might be like an OTC deal with the treasury, etc. And you can kind of sponsor that deal and effectively go out and get people a great deal on OTC tokens in Aave or something like that.
And how is that connected to Synthetix? Like it doesn't,
because I kind of came up with the idea, I guess. So that's it. Yeah.
It's not utilizing the Synthetix protocol.
It's not utilizing Synthetix. I mean, obviously some pools will use SUSD and SETH and things like that, but it's not immediately using Synthetix. It was more of just a kind of thought experiment that got out of hand.
And about these projects in general, I've seen some people on Twitter saying, it's new tokens. Why do they need new tokens? But for me, it makes total sense that these projects, in order to take a life of their own and not just become like little projects within, Synthetix, which has 1,000 things to focus on, they really develop their own community, their own tokenomics. Obviously, the danger is that it dilutes value from SNX, for example, in the case of Quenta. But I think there's a lot of upside. And if you look at protocols like Liquidity, I think it is.
Mhm.
It's a bit in that idea, right, where you have just different UIs and they have their own incentives they build their own
Exactly.
incentive systems on top
Exactly,
of
yeah.
Synthetix. Yeah, super cool. Very excited. Okay, that was it. Thank you so much for all the explanations.
No worries.
And,
My pleasure.
future's looking bright.
Awesome. Yeah, exciting. Thank you.